Have you ever looked at the market and wondered why a super safe government bond pays you next to nothing, but a risky stock has to promise a way higher return? It can feel kind of random, right? Well, it's not. Today, we're going to pull back the curtain and reveal the one single, elegant rule that explains why some assets are expensive and others are cheap. So here's our roadmap for this explainer. We're going to start with the most basic idea, the problem of risk itself. Then we'll get into the one rule that basically governs all of finance. From there, we'll see how that one rule lets us put a price on the future, and that's going to lead us to the big aha moment, why risky things have to pay you more. And finally, we'll touch on why the real world is always a little messier than the neat theories. Okay, first step, the problem of risk. Before we can even start talking about prices, we have to understand the fundamental reason financial markets even exist in the first place. And really, it all boils down to this one universal problem we all face. I want you to imagine you're a farmer for a second. You have no idea if this year's harvest is going to be amazing or a total disaster. Those are two very different possible futures, or what economists like to call states of the world. This super simple scenario, it actually captures the huge challenge we all face. How do we manage risk and get ready for a future we just can't predict? And that is exactly where financial markets come in. You know, they do three main things. They help us save for later, they help get money to businesses that need it, but the big one for our story today is the second point. They give us the tools to manage and share the risks of that uncertain future. All right, now for any of this to work, for prices to mean anything at all, the entire system has to be governed by one simple, totally unbreakable principle. This is, and I mean this, the absolute bedrock of all modern finance. And that principle is the absence of something called arbitrage. Now, in plain English, arbitrage is just a risk-free money machine. Think about it, a strategy that costs you nothing, or maybe even pays you, is guaranteed to never lose a dime and still has a chance of making you a profit. It's literally the free lunch everyone talks about. So the whole point is that in a stable, functioning market, these opportunities just can't exist. If they did, everybody would rush in at once, and that pressure would make the opportunity vanish in a split second. So for prices to be stable and to actually mean something, there simply can't be any free lunches. So if we accept this one really powerful rule, no free lunches, it actually gives us this incredible toolkit. It becomes the foundation for figuring out the fair price of pretty much any asset you can imagine. Let's see how that works. So the first tool we get is this idea of a state price. Imagine you could buy a special kind of lottery ticket. This ticket pays you $1 single, but only if it rains tomorrow. The price of that little ticket, that's the state price for the rainy day future. And if you could know the price for every possible future, you could price any asset just by adding up the value of what it pays in all those different scenarios. Okay, now you might be thinking, pricing out every single possible future state of the world sounds impossibly complex. And yeah, you'd be right. But thankfully, we don't have to. There's a much more elegant and, frankly, more intuitive way to get to the same logic. Let's think of it as a bad times multiplier. This bad times multiplier is all about a simple idea. $1 is worth a heck of a lot more when times are tough. Think back to the 2008 financial crisis. If you had just lost your job, an extra $1,000 then would have been life-changing. That same $1,000 today, still great of course, but it just doesn't have the same impact. In finance, this multiplier has a fancy name, the stochastic discount factor, or SDF. But let's just call it M. When times are good, M is low. But when things are bad, M is really high, which tells us that any money you get in that crisis state is incredibly valuable from where we stand today. And this just nails the core human intuition. $1 is worth so much more to you when you desperately need it, when your marginal utility is high, as an economist would put it. The SDF is really just the market's clever way of capturing this very real human feeling and putting a price tag on it. And that brings us right to the climax of this whole explainer. We can now use this powerful idea of the SDF to finally get a crystal clear understanding of the price of risk. So here's the crucial insight. An asset's price isn't just about how much it pays you on average. The really important thing is when it delivers that payoff. The price is all about how that payoff moves with or against our bad times multiplier, the SDF. And this lays out the entire secret. On the left, you've got an asset that acts like insurance. Think of fire insurance for your house. It pays you exactly when things have gone terribly wrong. Because that payoff is so incredibly valuable, you are willing to pay a high price for it today. And a high price means you have to accept a low or maybe even negative expected return. Now, on the right is your typical risky asset, like a stock in a company that sells luxury cars. It pays off big time during an economic boom, exactly when you need the extra cash the least. Because that payoff comes at the wrong time, the asset has to be cheap today. And a low price automatically implies a high expected return to convince you to buy it. That extra return, that is the price of risk. So this whole theory is just beautiful and elegant, right? But it is, of course, based on a kind of perfect ideal world. So let's take a moment to talk about why reality is always a little more complicated. The theory works perfectly in what are called complete markets. That's a world where you could buy an asset to insure yourself against literally any risk you could dream up. But our world is one of incomplete markets. I mean, think about it. You can't buy an insurance policy that pays you if your specific career suddenly becomes obsolete, or if you just don't get that promotion you were counting on. A lot of the biggest risks we face are personal, and you can't trade them, which means we can never fully protect ourselves using financial markets. And, even when insurance-like products do exist, they're often full of these real-world information problems. If you have full car insurance, you might just drive a little less carefully. That's called moral hazard. And the people who are most excited to buy health insurance are usually the ones who expect to have high medical bills. That's adverse selection. All these little frictions create gaps in the market, making perfect risk sharing impossible and leaving all of us to deal with more risk than we'd like. Okay, so what's the big takeaway from all this? Let's recap. It all starts with that no free lunch rule. That one idea gives us the SDF, our bad times multiplier, which just tells us a dollar is worth more in a crisis than in a boom. The risk premium, then, is simply the reward you get for holding assets that pay off in those good times. And finally, things that act like insurance are expensive, and they have low returns, precisely because getting that money when you need it most is so incredibly valuable. So when you really get down to it, the price of any stock or bond or anything else, it's not random. It's actually a really sophisticated collective mechanism for pricing our very deep, very human need for security. The entire market is constantly weighing and valuing all of our possible futures. This framework gives you a totally new lens to see the world through. Now, when you see an asset with a really high expected return, you can ask yourself, what's the bad state of the world this thing does poorly in that has investors so scared? So I'll leave you with this final question to chew on. If prices really do reflect our collective fears, what are today's markets telling us we should be worried about most?